Timing is everything when you're buying real estate. So the question is, when do you buy? Well, unfortunately, human nature is that there's a herd mentality. So people kind of buy together and sell together, typically. So when the market's going up, everybody buys together. And then when the market's going down, everybody sells together. Everybody has this follow the herd type mentality. And if you really want to get wealthy, if you really want to get ahead, the trick is to go contrary. So when everybody's buying, you're a seller. When everybody's selling, that's when you're a buyer. So when is the best time to buy? The best time to buy is when the market's at the bottom or going down. The best time to sell is when the market is going up or at the top. Now here's the problem with that. Timing cannot be perfect because you really don't know the bottom or the top until 6 months to a year after it has hit one of those levels. So the idea is not to go for perfection, but to just really pay attention to the market. And if it feels like it's at the bottom, that's the time to buy. Or if it feels like it's at the top, that's the time to sell. But if you miss the top and it's starting to go down a little bit, that's still okay. And if you miss the bottom and it's starting to go up a little bit, that is okay too. But you just want to be an early purchaser or an early seller to any economic cycle change. One of the most important things when you're looking at investing in real estate, and this may be different than when you're actually buying a home, because when you're buying a home, that's a whole different set of needs. You know, you need a place to put yourself, a place to live, a place to put your family. It may evolve around being relocated to a new job or having a baby, or maybe your children have left the nest and now you need a smaller property. So there's economic factors to consider, economic conditions, business cycles to consider, but there's also life cycles that have to be considered too when you're buying or selling a home. But when you're making a pure investment into a commercial property, maybe an apartment building, maybe into a strip center, there's a lot of factors to consider. Like, for example, what is the trend in the neighborhood? Is it growing? Is it building? Or is it going the other way? Businesses are closing, business is failing, and there's just some difficulty going on in the marketplace. Other things to consider are zoning changes. Are zoning changes favorable or unfavorable to the area that you're planning to invest in? So another very, very important consideration. Take a look at the zoning. Also, is it growing? Is it building? Is the marketplace actually developing, or is it going the other way? It's at the end of its economic cycle. And you have to just do some study on that. One good thing is to talk to realtors. Another thing is to go down to the city and see what's happening down there. So just be really, really investigative, I would say. Be curious and interested in what the trends are and those things going on in the market. One thing you could look at is population growth or attrition. It's interesting to see how sometimes people are leaving neighborhoods or leaving states and going to other states or other neighborhoods. A very, very important factor to consider. So get ahead of that. Take a look at the local laws, the actual requirements to build or remodel. Some areas can be extremely favorable and be encouraging growth and business development, and other areas may be clamping down and making it more and more difficult for new businesses to open. So make sure you're aware of all the building permit ordinances and requirements before you actually purchase a property. When looking at investment property, it's all about the math. What is the cap rate? What is the net operating income? What is the return on your investment? So make sure you really do the math. And if you're unsure how to evaluate a building, work with a good realtor or work with an accountant. But make sure that you study everything extremely carefully. Interview the tenants. Make sure the owner provides estoppel agreements for you, which means what the tenants are paying rent, what their security deposits are, what the length of their leases are, and make sure what the tenants think is happening is the same thing that the owners are saying is happening, so that there's actually a meeting in the minds there. Each area that you invest in is going to have a cap rate kind of average. And it's going to be based on the quality of the tenants, the quality of the neighborhood. If you're going into maybe more emerging or startup neighborhoods, the cap rate might be more favorable to a buyer. But if you're going into prime locations, the cap rate will probably be more favorable to the seller because the quality of tenants is better, the history of rent payment is better, the solidness, that it's just a more conservative, but more solid investment. And in some of these markets, the appreciation is actually better too. Do you need a team? You absolutely need a team. You need a great mortgage broker that can help you find financing. You need a great realtor that's going to help you analyze the property, work out the math on it, make sure that all the tenants are solid, make sure that the building is in great condition, that it's not full of deferred maintenance, to make sure that the property you're buying is going to deliver and not turn into a money pit, because sometimes they do, and you have to really pay attention to the condition of the property, the quality of the tenants, their rent payment history. All of these things are extremely important. Also, are there any hidden expenses? Like maybe there's a huge management fee, maybe there's a constant maintenance issue to the building, or there's some deferred maintenance that's going to pop up, like HAV or a bad roof, or maybe there's water seepage coming in from somewhere. So do very, very thorough investigations. Have a great inspector. Make sure they're licensed and insured, and that they absolutely know what they're doing when they're inspecting the building. If possible, have a great conversation with the owner of the property. Maybe you can develop some sort of an understanding and create a great relationship where they can explain to you certain things that you need to focus on. Also, seek out good mentors, seek out good advisors that maybe have invested in a way that you think has been very successful. Ask them how they did it. Maybe ask them how they got their first down payment. Sometimes we think that I don't have the money, I can't do this, I'm not ready to do this. Yet you can, and you probably do have the money, or you could probably raise the money if you had a good plan or a good property. It's amazing how people will invest with you if you have the right deal and the right plan. They will show up. But if you go to them without the right idea and the right plan, it's not going to be effective. They may say they will, but they won't. They won't put up money. But if you tie up a terrific property and it has great upside, it's easy to raise money for those kinds of situations. But ideally, I'm not a big fan of partners. And I know that people will probably argue with me about that because you can buy more when you syndicate money. But for me personally, I sort of want to be the owner of my own destination. I want to be able to sell when I want. I want to be able to buy when I want. I want to be able to remodel when I want. And I don't really want to talk to a lot of people about what we're going to do with the property. I like the freedom of owning things myself. So if you can buy for yourself and you don't have to have partners, all the better. One of my first investments was a rental property, and I actually bought it with a credit card. I used that as my down payment. And then I had another down payment I had to come up with later, but it was a series of money that I invested over time to actually purchase a property, beginning with a credit card, believe it or not. And so there are ways to finance things and do things, even if you don't have money. Get creative. Maybe it can be borrowing from a family member, something like that. So there's different ways to do it. If you have the money, absolutely invest in it. Invest it in real estate. People that are really, really good with money, they study money. They pay attention to their money. People that want to make money and create wealth, they study other people that have made money and create wealth. So reading the business section every day of the newspaper, understanding the financial markets, looking at where things are going, looking where consumer confidence is, looking at the inflation rates, looking at all the different treasury rates and all the different federal funds rates, all of those things, understanding who's in office, understanding their view on economy and markets and things like that. Be a student of money. If let's say inflation's 3% and your return on investment's 2%, you're losing money. Understanding these things is very, very critical. Like the value of $1 today is probably going to be less in the future just because of inflation. So having these basic understandings is going to help you tremendously as an investor. Don't get over leveraged. That's what happens to so many people. They get a modicum of success. Things are going well, so they double down. It's like gambling. Next thing you know, they're over their heads. The market takes a dip. They can't afford to hang on. Now they're selling at losses or losing the property in bankruptcy or foreclosure. You don't want to put yourself in that position. So invest, but invest wisely. I like a little more conservative approach. Make sure that in the worst case scenario, you're not going to have to sell your property or lose your property in a fire sale. Been highly leveraged, and I got stuck in a very severe recession, in the 90s. Had to sell some properties that I wish I hadn't sold. I've taken a much more, quote, cash and carry position almost in everything, where, there's very few things that I'll finance. And when I finance them, I make sure that I finance them, not even 90% financing. I like maybe 80% loan or less at best, just to make sure there's always enough equity in the property in the worst case scenario. I think conservatism is always a good philosophy. People that roll the dice like they're in Las Vegas, you can hit it big for sure, but do you need that stress? Do you want that stress? And are you willing to take that risk? And that's the big question.